Gold is at record highs. The macro case has never been louder. JP Morgan, UBS, and Goldman Sachs are all pointing toward $5,000 to $6,000 an ounce by year-end. Central banks bought roughly 850 tons of gold in 2025 and are on pace to match that in 2026. China's central bank alone has added to reserves for 17 consecutive months. And yet the three largest Canadian gold miners are performing as if they belong to completely different industries. Agnico Eagle is up 27.2% year-to-date. Kinross has gained 17.5%. Barrick is down 2.4%. The broader gold mining index has risen 12.2%. The S&P 500 has declined 3.6%. So gold miners as a group are outperforming almost everything, except Barrick, which is moving in the opposite direction entirely. That divergence is the tension worth sitting with. Because if this were simply a gold price story, all three should be moving together. The fact that they are not tells you something structural is at work beneath the price headline. Here's the part of the gold rally that the headline numbers obscure. The world's biggest miners are forecasting production declines for 2026. Not because prices are wrong, not because demand is soft, but because they are depleting reserves faster than they can replace them. Exploration budgets reached $6.2 billion in 2025, up 11% year over year, now accounting for half of all global exploration spending. That sounds aggressive, until you look at where the money is going. Grassroots exploration, the kind that finds genuinely new deposits, has collapsed to an all-time low of just 21% of global budgets. The rest is going into extensions of deposits that already exist. That is the industry spending more money to find less. The pipeline is narrowing even as the price environment has never been more favorable for new supply. This creates a quiet ceiling on the majors. Higher gold prices expand margins in the near term, but if reserve replacement is failing, production volumes shrink over the medium term. A miner with falling output and rising costs per ounce can see its margin advantage erode even when spot prices are climbing. Barrick's underperformance relative to peers may be a preview of that dynamic, not an anomaly. The World Gold Council has flagged this directly. New discoveries are drying up, and mine development timelines are stretching longer. That structural constraint does not disappear when gold crosses $4,000 an ounce. G Mining Ventures moved to acquire G2 Goldfields in a deal valued at approximately $3 billion. The exchange ratio carries a 72% premium based on 30-day volume-weighted averages. That is not a modest bid. A 72% premium signals that the acquirer believes current market prices are undervaluing what adjacent, contiguous ground in an emerging district is actually worth. The deal consolidates two gold projects in Guyana's Oko district into a single integrated complex. TD analyst Stephen Green noted the assets are effectively part of the same mineralized system. The likelihood of a competing bid is considered low. What that transaction signals more broadly is that majors and mid-tiers are now willing to pay steep premiums for permitted, production-proximate assets in politically stable jurisdictions. The reason is the reserve depletion problem. Buying a nearly built mine is faster than exploring for a new one. At current gold prices, the math on acquisitions closes more easily than it did 2 years ago. Agnico Eagle's pipeline tells the same story from the operator's side. The Hope Bay project carries proven and probable reserves of 3.4 million ounces. The Meliadine expansion was commissioned in the second half of 2024, increasing mill capacity to roughly 6,250 tons per day. Agnico is investing in known assets with defined reserve bases, the exact opposite of what the industry's grassroots collapse suggests most companies are able to do. The divergence between Agnico and Barrick may come down to exactly this. One has a clearer near-term production growth path from existing assets, the other faces more uncertainty on that front. The bull case for Canadian gold miners rests on three conditions holding simultaneously. Gold prices need to stay elevated, which requires the de-dollarization and safe haven demand narrative to remain intact. Reserve replacement needs to remain structurally difficult for the industry, keeping supply constrained. And individual operators need to execute on their existing pipelines without cost overruns. If all three hold, Agnico Eagle's current trajectory looks well supported. Its above 200-day SMA position since March 2024 reflects sustained institutional conviction, not a short-term momentum trade. Kinross, up 17.5% year-to-date, is tracking the broader industry move with reasonable fidelity. The reversal case is less obvious but worth tracing. A diplomatic resolution to the trade tensions driving safe haven demand could deflate the macro bid quickly. Gold moved on news of a pause in the Iran conflict, That kind of geopolitical sensitivity works in both directions. A sustained easing of trade war pressure would likely pull institutional flows back toward equities and compress gold's premium. For Barrick specifically, the downside and the recovery path are both tied to operational execution. If reserve replacement efforts show measurable progress and cost structures stabilize, the stock's underperformance relative to peers becomes a valuation opportunity rather than a warning sign. The evidence does not clearly support that reading yet, but it is the condition to watch. The structural argument for gold miners is durable. Sovereign buyers are not acting on short-term price signals, and the supply pipeline is genuinely constrained. But the spread between Agnico's 27% gain and Barrick's 2% loss is a reminder that macro tailwinds distribute unevenly. Owning the sector is not the same as owning the performance.